Hello, everyone, and good afternoon. Welcome to the Miller Value Partners Live Quarterly Update, April 2024. I'm David Yazdan, Head of Investor Relations for Miller Value Partners, and I'm joined today by Bill Miller IV and Dan Lysick. Today, we have a full agenda, so let's get right to it. We're excited to share more about our newly launched exchange-traded funds, the Miller Value Partners Appreciation ETF, symbol MVPA, and the Miller Value Partners Leverage ETF, symbol MVPL. In addition, Dan and Bill will highlight new investment positions and give updates on a few existing holdings. They'll each provide color on the current investment landscape and how that may inform their bottom-up investment analysis. Then we will open it up to Q&A per usual. Regarding the Q&A portion, that's going to be at the end. If you have a question, you can click on the Q&A icon at the bottom of your screen, type your question, then press submit. If we're unable to get to your question on the call, we will follow up with you directly after the call. So before I hand it off to Bill, I'd like to mention some of Miller Value Partners' key guiding principles, starting with our commitment to alignment. Alignment is important. For example, we're the largest shareholders in the Miller Value Funds, in our commitment to be invested alongside you, our fellow shareholders. Alignment also holds true in our investment holdings, and we do hold our management teams to the same level of alignment as us. The next is flexibility. What do we mean by flexibility? We believe that having flexibility in our research approach allows us to think creatively, to think and act differently than most of our peers who need to manage to a certain style box or index. And then finally, transparency. Critical to building strong bonds with our investors, we provide our partners with transparency in our process and in our portfolio. It's important that you know what we own and why we own it. Please visit our new website, millervalue.com, and follow us on X for content and updates. We welcome your thoughts and feedback as we strive to continually improve the client experience. So with that, I'll hand it off to Bill to share our Q1 market observations and set up for Q2. Bill?
Thanks, David, and thanks everyone for joining us today. I'm going to start with my investor letter that went up on our website today called Staying Flexible and Concentrated in a Time of Froth. I generally like to look across the capital markets, starting with the bonds and how each section of that market did every single quarter to get a feel for what's going on out there. And so if we look at the last quarter, risk in fixed income actually did really well. Triple C's did better than double B's, which did better than single B's. High yield did better than investment grade. Why is that? Mainly because the economy remains really, really strong. The big story this past quarter was inflation popping again, which is funny because I have egg on my face, given that previous quarter I wrote in our shareholder letter that the extreme strength in both bonds and equities could have been a sign that market psychology was changing on the Fed's control over inflation. I still think they have it largely under control. Of course, the bond market now went from an expectation of an annualized rate of inflation over the next 2 years of 2.1% at the beginning of the quarter, way up. It surged to 2.7% annualized, obviously with CPI inflation readings coming in hot. But again, the overall economic momentum here is really, really strong. And what that's done is push valuations on our benchmark to near multi-decade tights. So if you look at the marginal amount of yield you're getting from high yield over the relevant treasury rates, it's really, really tight. So what are the implications there? The implications are you want to look for things that are mispriced and concentrate in them. So we had a really good quarter last quarter. We're really optimistic about our strategies. If you think about the past, when inflation in the market continues to run hot and rates are moving higher, historically speaking, that's a really good environment for value investors. Again, we have a flexible definition of value, but we do own a lot of things with low multiples, and that's a really good environment for us. Not as much for our benchmarks. So we're really optimistic about where we are. I'm going to turn it over to Dan who's going to talk more about valuation dynamics in markets, concentration dynamics, and also why he thinks our strategies are really set up to do well today.
Great. Thanks, Bill. We have a couple slides that we put together, kind of similar to the past couple quarters, and I like to run through just to kind of set the table for what we're seeing in the marketplace. So if you look at the first slide, it highlights kind of market concentration and long duration equities are kind of expanding market valuation, similar to what kind of Bill had highlighted on the fixed income side. If you look at the upper right-hand chart, it's a 30-year historical 4 PE for the S&P 500. The gray line is actually the top 5 market caps, which back in 2023, their P multiple was near 20 times. So over the past 5 quarters, that's expanded to 32.5 times. So now at a 3% earnings yield. And so today is not far from kind of, you look back to early 2022, and it's really only been higher for that portion of the market going back to the high 1990s. So with the top 5 kind of near record weighting in the S&P 500, it's dragging and kind of increasing the overall P multiple of the market, which is the red line at 21.4 times. However, what's not in this chart is also influencing valuation expansion is the longest duration subset, where the top decile has a median PE that closed the quarter at close to 50 times, which is at the end of the first quarter. That subset is actually more than 18% of the market too. So again, you're seeing concentration in more expensive equities that are kind of increasing the overall benchmarks. If you look at the chart at the bottom, what's interesting is valuation multiples for different subsets of the market. Longest duration equities, which have the greater concentration, are more growth oriented today, but increasing the overall valuation of the market, which we think is becoming kind of a hidden risk for passive investing. But if you look at that chart, the lower valuation subsets of the market are very attractive. And on an absolute basis, you're getting high single digit earnings yield today, which is nearly 2x the S&P. And it's still possible to find mispriced companies at 20 to 30% earnings and free cash flow yields. But in most cases, those are kind of lower weightings today than the passive index. On the next slide, you can see the chart on the left looks at 30-year performance of the S&P 500 equal-weighted versus market-weighted, and also value versus growth. And what you can see there is both are highly correlated. So when value outperforms growth, the average S&P 500 stock tends to outperform the S&P 500, which isn't really surprising because the equal-weighted would have a greater representation of lower valuation securities. On the right scale, it's rare to see value underperform growth by more than 20% over a trailing year. On the left side, it's also equally rare to see equal-weighted underperform the market cap by more than 10%. Past 30 years, it's happened 3 times, late 90s, COVID outbreak, and then early 2024. And then following the 2 prior troughs, the average S&P 500 stock and value significantly outperformed going forward. And if you look at the chart on the right, it'll give you a little reason as to why the market and the higher, more concentrated mega caps have been outperforming. The earnings growth has been very strong. Non-Magnificent 7, the bottom 493, actually have been an earnings recession in 2023. That's expected to end this quarter, and year-over-year earnings growth is going to improve looking out over the next couple quarters. And you go late into 2024 and 25, you're actually going to see them start to lead the market. And the market's forward-looking. We think that's going to help the market further broaden and help value continue to do well over the next 12 months. And then the final slide, here we want to just reiterate how attractive small caps look today and poised for a multi-year outperformance cycle. The left chart highlights rolling 5-year performance of small versus large since 1930. It's been a very difficult last 5 years for small caps. It's significantly lagged, and they're on the 8th decile. And as you can see from the chart, these extended time periods are usually followed with small cap, outperforming pretty well. And you saw that in 1970s and also after 2000. In the upper right-hand box, which is interesting, it's looked at this historically, as small cap is now less than 4% of the U.S. equity market. It's actually lower than where it was in the COVID lows. You need to go back to 1930s, find a lower weighting. And you would actually need to have small outperform large by nearly 100% to get back to what the long-term historical average is. In post 2000, we saw that. Looking at the chart, you can see how that dipped down 2000. Post that time period, small cap value generated 16% annualized returns over 6 years, while the market was up low single digits over that time period. So finally, I want to just come to full circle. The bottom right-hand corner, well, we started the conversation on top 5 market caps. Today, they're actually, when you look at them versus the Russell 2000, the top 5 are 3 times the entire Russell 2000 index. That's more than 2x the levels of the late 90s. So again, also on the red line on that chart, top 5 combined price to sales has expanded up to 7 times. That's nearly 3 times the overall market, 7 to 10 times lower valuation small cap universe. So I think this looks and appears to be a great time to invest in high active value strategies that have kind of greater exposure than small caps and lower valuation than the overall market. So I'm going to turn the call back to Bill, who's going to discuss the timely launch of our new flexible and active ETF MVPA.
Thanks, Dan. I appreciate it. Let's actually start with, we're going to go over all of the portfolios in this section. We'll start with the income fund just because that is our largest fund. I want to go back to actually some portfolio level characteristics and talk about why we think it's really attractive. The price to free cash flow multiple in our income fund, ticker LMCLX, by the way, price to free cash flow multiple on a trailing basis, 7.2 times. The market trades at 31 times. So it's a 77% discount on a price to free cash flow basis. Again, most of everything pretty much that we are buying, there's a strong level of alignment between the management team, the capital actions, and the incentives. So a lot of these guys are returning this cash flow directly to shareholders, buying back stock, paying down debt, doing all the value creative things with it. And again, it's a massive discount to the market. So we really like what we own. The EV to EBITDA multiple on a trailing basis for the income fund right now, 4.9 times, S&P 15.3 times. EV to sales 1.1 versus SPX at 3.1. And it also skews on the small and mid cap side. So Q1 was a really good quarter for the fund. As I mentioned, it is an actively managed product, so we have made changes to it. We continue to cut back on our mistakes. We no longer own Medical Properties Trust. After they came out and announced another investment in an affiliate after a misstep, we said no more of that. And basically, fool me once, shame on you, fool me twice. So we got rid of that. We got rid of a few other mistakes, and we added to a handful of things where we think there's a really compelling risk-adjusted return profile, and we'll get into stock ideas at a later part of the call. But I did want to cover what we're doing in the income fund before moving on to the ETFs. We did launch 2 new ETFs this quarter. We do not have any new product launches planned at any point in the near future. This is sort of our product suite. The idea was we had a product whose goal was to outperform the high yield benchmark, and we wanted something that could have a higher rate of return in a public fund structure. And so we wanted to outperform the market. And there's 2 ways you can do that. You can do that by managing systematic risk, right? Market-based risk and your exposure to it, or you can manage it by controlling what's in the portfolio and what the weightings are. So that's managing unsystematic risk. And each of these 2 portfolios does those 2 things. So MVPA, Miller Value Partners Appreciation, that's a ticker, MVPA. The goal there is to own undervalued names that can compound at a high rate of return for many, many years. So we want to enter at a good price. We want to enter when technicals make sense. We want to trade around those, not trade around those names, but adjust the weights over time relative to their valuation and other characteristics and risk-adjusted return profiles over the long term. Had a really good quarter that launched end of January. It's only been out for 2 months, but it's done really well. Again, MVPA is the ticker there. The one where the process is going to be less well known from our longtime followers is going to be MVPL. That's a systematic leverage approach to managing risk in the market. It varies between 2 states. One of our longtime followers and friends of the firm said that my dad's approach on the market, view on the market, varied between bullish and very bullish. That's what MVPL does. So we vary between just being an SPY to going in 2 times leverage SSL. And we're doing that using a systematic approach, data-driven approach. And the whole idea is effectively systematic risk with some systematic risk control over a long period of time, assuming you can tolerate a little volatility with this IP. We are using very strong first principles ideas here to manage leverage And the math is really, really compelling, as are some SSRN notes that have come out on just general links to the IP we're thinking about in this portfolio over time. So we're really excited about that. It's done exactly what we thought it would since launch, and we're excited about that portfolio's prospects. But I know a lot of callers here want to talk more about stock ideas. That's what we're known for. So we're going to go on to that portion of the call at this point. Dan's going to kick off with a couple ideas that are in both portfolios, and then I'll go over a few myself, and we'll go on to questions. So Dan.
Great, thanks, Bill. So I'm going to start this quarter. Actually, I have a slide that we're going to put up. I want to highlight Lincoln Financial National. So the symbol is LNC. Shares are $29 a share. So you can see from the orange part of the chart, it's off its lows in 2023. The stock's still down 60% from its highs in 2021. Lincoln's had some headwinds in the recent years from its life insurance business and some profit challenges as a result of the COVID outbreak. Been a new senior management team. It's been elevated and been strengthening the company's balance sheet, focusing on more capital efficient new business and improving kind of long-term free cash flow generation, which is a new focus for the company. Lincoln's also undertaking additional cost actions, which is going to help profitability this year. And a lot of the headwinds that were in the life segment, which made that segment at break even, appear to be poised to turn the corner and become tailwinds next couple of years. So we see success on accelerating organic growth through the new product offerings and new focus of management to support double-digit operating profit growth in the next couple of years. And normalized free cash flow should be in excess of $1 billion, looking at free cash flow conversion improving. And as you can see from the chart, the blue line is the forward PE multiple looking out 2 years. And at current levels, it's less than 4 times. And so we look at this as being an opportunity of catching a company that is doing profit improvements and has valuation improvements that can lead to a compounding effect of return next couple of years. Lincoln also has an attractive 6% dividend yield and low payout ratio. So if we go back to historical valuations that you see there, if you look, that could be north of 7-8 times on a PE basis, and narrow the gap to the peer group. The next chart, on a brief comment, we mentioned last quarter, Gray Television share price lagged to start the year with slower start of political advertising. However, we still think presidential election, usually advertising is later in the year, and that's $500 million plus of high margin free cash is going to come into Gray later in this year. If you look also at their leading television stations, they're in 113 markets, so they have strong audience reach. It should position them to continue to grow organically faster than the peer group as they're looking to double their advertising market share. So $2.5 billion free cash flow potential next 5 years. The shares look really mispriced. The chart highlights on a price to free cash flow basis, it's near 1 times. You have to go back to the Great Recession to find a similar valuation level. And the stock compounded multiples off that point historically. So we see also with the significant reducing of leverage next couple of years, limited near-term maturities, their long-dated debt, we think is severely mispriced as well. And then lastly, I want to highlight in the energy sector, in our opinion, while it's been doing a little bit better recently, we highlighted last year how we thought it's significantly mispriced, remains in our opinions, very attractive. The weighting of the S&P for energy is only 4%, but the income contribution, the S&P is 8%. So opposite of, if you look at the technology sector where the P multiple is much higher, the contribution to on a market cap basis for tech is close to 30%, much lower from what their income contribution is. In energy space, supply demand remains favorable. That's good for long-term energy prices. And most companies have repaired their balance sheets. So you're going to have an ongoing return to shareholders, which I think is very positive for the industry. The chart that you're looking at there is Neighbors. Again, the valuation is near 20-year lows, 1 times cash flow. This chart is EV to EBITDA multiple. It's only at 3.5. There's ongoing debt reduction still for Neighbors. That's $1 billion that we look over the next 3 to 5 years. That's more than the market cap. And we see their international segment, which is large and re-accelerating next 3 to 5 years, can drive EBITDA in excess of $1 billion too. Normalized free cash flow, we look at 5 years, looks like north of 50%. So the upside potential here is more than 5x where we're currently at. People tend to forget the reverse split. Neighbors currently is only $1.60 free split, and it traded well in excess of $10 historically. And I think Paulo recently became a top 10, one of the largest shareholders. And again, I'm going to turn the call back to Bill. He's going to highlight another significantly mispriced energy name that we like.
Thanks, Dan. I'm going to mention a name that we recently added to the income fund in a big size, one of our larger weights at this point, almost 5% weight. It's a company called Chord Energy. CHRD is the ticker. We love it for all the Miller value reasons. So it has a hugely aligned management team. 70% of comp is at risk. They've also done what they said they do, and the stock still trades a really cheap valuation. So the EV to EBITDA multiple on Chord Energy on 24 this year is 3.3 times, 2.7 times on next year. These guys have been really good executors. The stock's also breaking out to an all-time high, still cheap. Management's aligned, it checks every box. I mean, estimates are rising. They have a really value accretive strategy in the Williston Basin to roll up operators, and they've been doing that in a really cost accretive way. So we love Chord Energy, checks every box, still cheap, management's aligned, pays a big dividend. Oh, what I really like is it pays a variable dividend, which is a capital allocation strategy that makes more sense than having fixed dividends when you don't know what your earnings are going to be. So everything here is aligned, and we love Chord Energy. So I'll give you another one here that we own in MVPA. It's currently a 4% weight. We really like it though. Coupang. We're coming out with our one-pager on it in the next few days. It's in compliance, so you'll be able to read through this on our website imminently here. CPNG is a ticker. Coupang is the Amazon of Korea. And the reason we love this stock is because the valuation is actually super cheap. If you look at it on a PE basis, it's not all that cheap, but if you look at it on a cash flow basis, it's really cheap. If it trades at 1 times the EV to sales right now, which is where Amazon has historically bottomed, and they have tons of growth runways. They have a single-digit share of Korea's commerce market. They have 100 different fulfillment centers in the country, which means that 70% of Korea lives within 7 miles of a fulfillment center, which is why they can deliver things so quickly. But again, this is a really compelling opportunity over the long term. You have an aligned management team that owns 10% of the thing, billions of dollars, acts like an owner, communicates like an owner. And so we really love Coupang. Those are my 2 ideas for the call, and we'll turn it back over to Mr. Yazdan for the questions section.
Thank you, Bill. So again, as a reminder, if you have a question, you can look for the Q&A icon at the bottom of your screen. If you can't see it, go to the right and hit more. It'll give you more options. Click on that, type in your question, and then press submit. We'll wait a few minutes here, but looks like the first question is for Bill. It's on MicroStrategy. How are you thinking about its valuation and how to size the position across your portfolios? Bill?
Thanks for the question, David. It's a very good one, considering that it was the largest contributor to both MVPA and the income fund, where we own the convertible bonds in the first quarter. Astute followers will notice we cut those back significantly because they got to be too big a portion of, I'd say, the risk of the portfolio. The thinking was at the time, MicroStrategy surged on massive volume to the point where it traded at a very, very large premium to its Bitcoin holdings, plus roughly the value of its software business. Now, I'm not implying that MicroStrategy should trade at the value of its Bitcoin holdings plus the value of its software business. I don't think that's right either. It should trade at a premium because in reality, if you own MicroStrategy, you have a big option on Bitcoin becoming one day, long-term, down the road, world's reserve asset class. And you will then own the world's largest holder of the world's scarcest reserve asset. So there's enormous optionality from a business perspective in owning that. I think the capital markets are appreciating that to a certain extent. If you look at the convertible bonds that MicroStrategy issued in the first quarter and their implied cost of capital. I mean, no one else can do that. ETFs can't accrete Bitcoin per share by doing that sort of thing. So you have a call option also on the accretion of Bitcoin per share through the intelligent capital allocation strategy and selling shares at premiums to where what they're actually worth, and then using those proceeds to buy more Bitcoin. So the short answer is there's not a science to it, except that if it should probably not trade at the biggest premium ever, given that there's more ways to access Bitcoin in public markets today than there's ever been. So it shouldn't trade at a massive premium. It should trade at some premium. There's puts and takes here. It's more of an art than a science at this point, but we still love the opportunity longer term.
Okay, thank you for that. The next question is first a thank you for the call. What do you see as a catalyst for Chord Energy, as well as what makes you keep or buy positions for at least 10 years, not going anywhere?
Continued execution and behavior from management teams that act like they're aligned and continuing to grind on the strategy. So for a catalyst from Chord Energy, I don't know that there has been a catalyst, and the stock's done amazingly well. So I don't know if there needs to be a catalyst when it's trading at the valuations it is, as long as they keep executing, buying back shares, doing smart things with their money, and acting like shareholders. So I don't know if there's an exact catalyst. I mean, the momentum is a catalyst in and of itself, some would argue. The deal that they just did with Enerplus was compelling, I think. We're excited about that, and we think there's more deals to be done. So we could view that as a catalyst. I don't know if it's needed as a catalyst.
Okay, thank you for that. I got a question, looks like for Dan. Dan, do you still see value in Fossil? FOSL is the symbol.
Yes, we do. Actually, coming up in our quarterly letters, you actually will see a write-up on that. The stocks obviously had a more difficult end of last year and beginning of this year. They're going through, for anyone on the call, multi-year transformation, taking out about north of 25% of the cost structure, getting rid of their connected watch business, which is at a lower gross margin, and also non-profitable stores. And so success on that, we still believe, looking out, you have a company north of $1 billion in revenue that could generate 10% EBIT margins. And stock today is trading below cash in the balance sheet. So again, it's a longer term turnaround. This is a micro cap. We want to make sure people are aware of that. But we still believe that the transformation opportunity set could be meaningful to the share price in the long term.
Okay, thank you for that. Next one is on Builders FirstSource. Do you think rates change your opinion on Builders, BLDR?
Rates have been going up in conjunction. I understand the spirit of the question. Obviously, if rates go up, home sales slow because they're a lot less affordable. Won't that slow things down for builder? Sure. In a vacuum, this builder stock has been soaring since rates started soaring too. So there's a valuation situation there. Is it as undervalued as it was a year and a half ago? No. Can it withstand the rates being higher? Yes, rates are higher because demand for housing is incredibly high and demand for what they sell is really high. And they have a very natural, I don't want to say monopoly, but they've got a very strong competitive position that they're building, which means their multiple should continue to expand as they continue to gain that clout. And it's just a really well-run company. NBC, same thing. Great cash flows, great valuation, great management. Understand that it's, rates mean that it could pull back. We don't trade around that. We still think these are compelling long-term values.
Great, thank you for that. Next one is for Dan. Dan, can you share your thoughts around CTO, as it seems different than your other investments and is the only REIT?
Yeah, I'm going to turn that one actually over to Bill because I'm less familiar with CTO. I think that's actually one that he owns currently.
Okay.
Yeah, that's one of our larger positions in the income fund. 9% dividend yield. It's a real estate investment trust. We like it for a couple of reasons. First and foremost, their properties are all concentrated in growing, well-run states. And that's really important in real estate, is that you need that underlying secular growth to keep things moving and rents moving up and vacancies getting filled when things fail. And so all of these things, properties are in really well run states. The management team here, again, owns a lot of the stock. I know John Albright. I've known him probably for a decade plus. He's a really good guy, smart operator, and they've done a really good job over a long period of time. The portfolio's in a really good shape. They also own, if you buy CTO, you also get the manager to a few closed-end funds along with that. So it's a really good value, tons of cash flow, dividends incredibly well covered. There's a few things out there with a 9% and rising dividend yield over the next few years.
Okay, great. We have time for one more question. This one is for Bill again. Thanks for the great insights. Would love to get your thoughts on Encore Wire Corp based on the current valuation. Can it be good entry point at current levels long term?
Yeah, the chart looks great, right? But the valuation has come in a little bit, given that it's popped as much as it has. You're going to hear me saying the same stuff over and over about a lot of these names, but it's a good thing. Massively aligned management team, tons of free cash flow, really well-run business. It's still not crazy expensive, and it's going to be tied to industrial or just general economic output over a long period of time. And commodities too are going to have something to do with it. So the commodity tailwinds helped in the past quarter or so. It's still a good value, which is why we still own it. And it's one of the, this is the same with Chord and any other commodity business like this, is that you have to understand these are not always great businesses, but people that understand that and allocate capital like owners over a long period of time keep you out of trouble, keep the balance sheet clean, and allow you to outperform and sustain where other guys are going bankrupt or not seeing a lot of landmines. So we really like it over a long period of time and still own it.
Great. Thank you both for those answers. And that concludes today's Miller Value live discussion. Thank you all for your continued interest in Miller Value Partners. To our clients on the call, we thank you for your confidence in us and look forward to a long-term partnership. You can subscribe to our email updates via our website, millervalue.com, and you can follow us on LinkedIn and X. Again, we welcome your feedback and hope you found this live discussion helpful. We look forward to updating you again in early Q3. Have a great evening, everyone.